So this afternoon, we are looking at, this is breakout session 2, and we want to talk about money. There's someone who has said there's money. So let's see where that money is coming in and how we can be able to leverage on what they're offering. All right. So my name is Muriithi. I am based at Strathmore Business School. So some of you will wonder what is happening here, right? So this afternoon, I want to invite, hopefully we have all the gentlemen here and the lady. So I'll start by inviting to the stage Muathi Kilonzo, the MD of NCBA Bank, Investment Bank, a subsidiary of the NCBA Group. Welcome. I will just do a brief introduction. He joined NCBA in 2005. And prior to that, he has worked as a managing director, EFG, Hermes, and also Exotic Partners, Renaissance Capital, and Morgan Stanley in London. So he brings a lot of wealth of experience across different markets. So secondly, I will invite, is Joseph here? Njuguna? Brilliant. Come on stage. He's an energy finance specialist at UNDP. Looking at Kenya, focal point for energy growth in Africa. FOG, Karibu. Again, wealth of experience. I will invite Winnie. Should I pronounce the second name? Shwashwa. Okay, Shwashwa. Right? Don't ask me how it's spelled. You tell us how to pronounce it. Sorry if I'm murdering your name. She's a CFO with a proven track record in financial and thought leadership at Equator Energy. Karibu. Asante sana. I will invite Robert Marete. Robert has introduced himself. He's spoken. He works for NCBA as well with over 20 years experience in leasing. So you talk about how we operationalize that. Karibu. And then finally, Nicolas, right, an associate at FinerGreen Energy. So does advisory. Karibu. I will not attempt to pronounce your second name.
Lefebvre, easy. Don't say the B.
Okay, that's French.
Yes.
Oui. Okay. Yes. Thank you so much. So we will like to start the panel, and what I will do is I set exam. So I set an exam and gave them a very easy question each to answer. And then I have a secret exam that we'll have to answer, and then we'll come back to the panel. The panel is an hour, so we'll try to spend as much time having a conversation, and hopefully all of us will take away something from the conversation we're going to have today. So I want to start off with Kilonzo, and you've worked in the banking sector and also different places that you've worked. From your experience, I just wanted to understand from your experience in financing, particularly with large-scale infrastructure and PPPs, just tell us a little bit about the bankability criteria for captive power projects in Kenya today. So what are you looking at when it comes to developing captive power projects?
Good afternoon, everyone. It's always quite risky or maybe lucky to be the first one after lunch. So I'll count myself lucky. But look, I think some of the things that we see, and I'll talk about not just captive power, but maybe more projects that have come by my desk in the last 12 months. I think the one thing that lacks in this market is equity. I think sometimes we see products or projects where people are masquerading debt as equity, so the structure is not right. So I think that's one challenge that we certainly find in making something bankable. And perhaps it's the structure of this market where locally it's sometimes quite difficult to find someone to help you write that equity check, or for whatever reason. So that definitely is something that comes in, and that really impacts the structure of the type of investment and the type of financing people want to get. Because once we start looking through that, the question is always, does the sponsor or promoter have skin in the game? And I think that's a really important thing to do, because the rest I think is kind of fairly obvious in the sense of, do you have your contracts, do you have your financing in place, etc., all that kind of things that you're thinking about. But I think we really need to think about the source of that equity check, and where it's coming from and who's going to provide it. Is it local? Is it foreign? That I would say is what the primary reason. I mean, we can make up all sorts of other reasons why things can fail. They may not pass through a credit committee, but ultimately I think it comes down just to the basic structure of the sort of entity that's being financed. I think another thing, and this is maybe perhaps infrastructural, is to a large extent, I think to a lot of banks, this is kind of new. I mean, you saw my colleague Marete present earlier what we're doing with leasing solutions. But I think to a large part of the market, some of these things are not necessarily seen as quite interesting. And that really is a function of just how profitable for a very long time, very boring banking has been. You know, it's been very easy to take cheap deposits and lend them out at a very nice premium or a spread. But I think that's changing now. So I think definitely the financing side is going to have to become a lot more sophisticated, and come to the table. Thank you.
So, Winnie, a quick question to you as a developer. What are the biggest barriers that you face when transitioning from an idea to a project?
Thank you. So for us in the developer space, of course, the first thing is finding a project that makes sense. It's big enough, it will earn enough cash flows for you. You've got the funding in place, of course, that is, typically for us, it's a mix of sponsor equity and project debt. And once you've got that, you then want to be sure that you're able to get the payback within reasonable time, a time frame, and a return on investment, within that meets your criteria. So usually it is quite challenging, especially in markets like this where trust levels are low, to get people to sign up for 20-year PPAs. And also on our part, there's the credit risk where you're expecting that businesses will stay stable. The load profile that we've designed for actually comes through, that conditions don't change as they normally do in volatile markets like this. There's also a big challenge on the funding side of it in terms of the mismatch between the funding being typically in hard currency, USD, but the local revenues are in local currency. And so you find hedging instruments here just don't make sense. We do have people like TCX, who you've probably heard of, but if you try to simulate with the way they price the hedge, you'll find that there will be no saving ultimately when you bake that into the tariff that you're going to give the customer, and so there'll be no saving for the customer. And customers are only coming to us to reduce their solar bill, so they're not coming to us because we are nice people. Solar is just really an input for them. They have a core business they're running, and they simply just want you to give them cheaper solar. So yeah, I would say those are the biggest challenges.
All right. Thank you so much for elaborating on some of the challenges you face. So I'll just come to Nicolas. Tell us a bit about from your work and advisory that you do. What distinguishes a finance-ready captive power or generally power project from one that struggles to reach a financial close?
Yeah, sorry. So I would say it depends a bit on how most of the risks are taken into account and mitigated. First one is around the risk of the client, the off-taker risk, whether it has ability to, on the long term, sustain payment and whether its financial will remain healthy. So usually that's the reason why we tend to raise at portfolio level or at developer level to spread a bit the risk over the whole portfolio. On top of this, there is obviously the PPA structuration, whether, as Winnie was saying, it's taking the risk of the FX risk into account, same whether it's a take or pay, etc. And to make the question a bit broader, as I was saying, we tend to raise financing at portfolio level or at developer level. So it also depends on the quality of the CNI developer. So basically the quality of its processes, to materialize the pipeline, obviously, but also whether it has internal capabilities in terms of EPC, O&M, or good framework agreements for those tasks. And the quality also of the financials of the CNI developer, making sure it's lean and can keep the OPEX low. In case, the pipeline is slowed down for any reason, for instance.
Right. Could you just tell us as an example of what one of the projects you've had to come in and turn it around? Maybe some of the things that you looked at, how you structured it to become successful.
Yes, sure. So we've been working on the CNI company in Kenya, actually, rather small one. It's still confidential, but we've been working on it for a few months now. Basically it's about how we've been working on the debt raising. The important was to take into account the pipeline risk quite a lot for the debt, trying to structure all the tranches to size them properly, because we know there will be delays. How to take into account this risk and making sure even in case of, stress testing our models to make sure even in case of pessimistic pipeline, pessimistic economic situations for the CNI clients, we could still repay the debt, basically.
All right. Okay. Thank you so much for that example. I'll just turn the mic to Joseph. You support the ecosystem, and I would just want to hear, before we can get more deeper into some of the examples, from a policy and ecosystem perspective, what are the biggest gaps currently limiting investment in some of the power solutions in Kenya?
Thank you for that. I think I'll basically focus on 3 key points. One is the issue of implementation clarity. Yes, in Kenya, there are very good regulations, and I can say we are very quick in formulating regulations for many things. But when you look at the actual implementation, do we have clear procedures, timelines, and even clarity for developers? For example, I know there are some projects that were formulated 10 years ago. Up to today, they still don't have PPA. I know in the same scenario, a project that was formulated 2 years ago, today they have a PPA. So as a developer, what does that mean? In terms of clarity, yes, the moratorium was lifted, but we still have very many gaps, and that has been an impact even for the project that I'm working on, Energy for Growth Initiative in Africa. We have been looking at some of the projects that we could finance, but we realize that there are still very many gaps and also barriers towards actual financing from DFIs. The other issue that I would like to touch on is the issue of project economics and bankability. I think that has been mentioned. Yes, the demand is there. Let us all agree. But when you look at some of these projects, they are small in size, not in our eyes, but in the eyes of financiers. They think that the transaction costs are quite high. For example, at the Energy for Growth, when they started, they told us the minimum ask is $10 million. But now, when you look at some of the projects that would have an impact at local level, maybe they will not go for that. Maybe they will ask something slightly small. So we had to talk to project financiers just to tell them, please bring this cap maybe to a manageable level. But also, we are still left in a situation where some of the projects, maybe the payback period is quite long, which will not be appealing to some of the DFIs. The last issue is on the issue of local currency and the tenor. Yes, the revenue is local currency. Maybe the duration is quite short, and you have to pay the loan in terms of USD. So those are the three key issues that I would point at this point. Thank you.
Thank you so much. Very elaborate and also very specific. I just want to come back to maybe Robert. I'll bring you to the conversation after this question, so that you come in with what Winnie maybe supports. So Winnie, so you've looked at financing your projects. What are some of the models that you've maybe looked at or used, and how are these viable from your perspective? And probably if you can just bring in, so I just want to bring in Marete in this, looking at solar projects, if you have worked on them.
Yeah, we've seen that there's been a shift away from African companies owning. So we've seen a rise in energy as a service. As Equator Energy, we are in the energy as a service space, where we develop, we finance, we operate the asset, and the customer just has to pay for the solar that they use, which would be different from what Robert would speak about in the leasing space. And this is valuable for customers because, as I mentioned earlier, most customers just want to grow their businesses, and so they're not really in the power of in the space of creating power. So they just want to know, what discount can you give me when you actually install? I don't want to worry about maintaining the system. I don't want to own it. I just want you to be another Kenya Power, but cheaper and hopefully more reliable, in short. Other models that we've seen is what Nicolas had also spoken about, and that we are using at Equator as well, which is bundling as many projects as we can from the different sectors into a special purpose vehicle. And we're finding that this helps us raise financing because, as one of the panelists spoke about, you'll find that lenders want to give you 10 million, but they don't want to fund multiple small projects. So if you can bundle them together, get to a certain size, then from there you can raise the capital you need, and you also reduce the risk of one customer, let's say, going bankrupt from in the portfolio. So we've seen a rise in special purpose vehicles. Another one that we haven't typically used at Equator just yet is the hybrid model, where you can have a potential customer pay a certain percentage upfront, and then the rest can be a PPA. And then I'll let Robert maybe speak about the leasing.
Right. Yes, Robert. You've quite marketed leasing. This is not one of the best things that we do here in Africa generally, and in Kenya we like owning our stuff, right? Yeah. If it's okay, say power. Power. You have someone building a house in the village; they want to own it in the city, right? So leasing is something that we're being introduced. So how can leasing help us solve this issue? And what does it mean when it comes to company financing?
Thank you, Dr. Muriithi, for that good question. And I'll take it back to you. A couple of years ago, maybe today you own a house. You obviously lived somewhere after high school, after campus, and before you found your way in this town. If you lived in that house for more than 12 months, you are actually leasing, but in another one. So if for some of us who come from the village, you found those small lights supplied by the micro lenders that goes off when you don't pay. they're actually leasing, but they just packaged in another way. So just to bring it home is that we are all used to the common asset finance where you go and for most of us who drive here, you took a facility from the back, backed by that same vehicle because you did not have another collateral. And now coming to the energy sector, the biggest question has been, is this energy asset bankable? And if you do not really understand the technology behind the life of the equipment, the cash flow that are coming in or are being saved in respect to that particular equipment, then you are unable to be able to convince any financial institution to lend you against that asset. But if you've properly invested in that, at NCBA, what you've done is to go deeper and beyond this, beyond the technical part, is to look at the economics of the asset. And then we've partnered with experts. Obviously, we cannot have all the expertise in the house, but we partnered with people who are basically experts in this asset, and they have convinced us beyond reasonable doubt that this asset, this is the kind of savings that we will have. And with that information, then we are able to package this asset in a way that we can convert it into a leasable asset. Either, like I mentioned earlier during the morning session, either in a way that you can have it for life, that is finance lease, or in a way that you can break up at the fifth year. This comes for possibly the technological items like batteries and systems that are not really ingrained to the buildings or the infrastructure. So we break it down into monthly, quarterly, biannually payments to the customer, and he reviews these against the bills that he pays to the grid, and we're able to convert this into a fixed or variable rate. Obviously, the fixed rate will be slightly higher than the variable rates, but then looking at it for the customer who is looking for predictable payment over the period of time, then you opt for this. We try as much as possible to stay below the KPLC bill for the reason to give you an incentive to keep paying even when times are hard. So, and then remember, if you choose to keep this asset at the end of say 5 years, then your bill goes to almost nil and you're left with only paying for the O&M. Thank you.
Thank you so much for that explanation on leasing. I'll ask a question at the end of it whether we are getting convinced it's a model we can use. But and I just wanted to understand, you've talked about bundling, you've talked about, so I just wanted to understand from a challenges perspective, what are some of the common structuring challenges you're encountering when it comes to power deals? And how can developers generally address this early in the project lifecycle?
Okay. So as Winnie was saying, usually we tend to raise financing at a higher level than that at project level. So I think it's quite important to have really standardized contracting and processes so that all the projects share similar properties. It's easier to get a credit line if all the underlying projects share those properties. So I think it's laid down to the PPA qualities for all of them, PPA properties, how are the risks mitigating in all those contracts. So yeah, the FX one was already mentioned, the grid tariff one as well is quite important. If it gets lower too much, it can be a problem for the client to stay with the CNI provider. And yeah, I would say also the quality of the portfolio is quite key here. So it's also part of the processes of the CNI developer to be able to identify which client will be profitable for a long time and will be viable for a long time.
Okay, all right, thank you. So I come back to Kilonzo. From from your experience in the world, and I think you've looked at various projects as well, and now you sit at NCBA, which I will call the power bank, because we have two gentlemen representing NCBA here. So my question to you is that how can corporates position their captive power projects to attract commercial bank financing rather than relying so much on DFIs? I know DFIs are also an alternative. How can you as a bank or how can corporates talk to you in a nice way so they can get financing? And look across board. Maybe you can talk about some of the innovative instruments probably you also have or have seen globally, or you're thinking about integrating into this market.
So your question is basically how to sweet talk the bank, yeah?
How can we get to your
sense?
To your pockets, not your...
Look, I think the DFIs occupied a space where the normal commercial banks were not very comfortable operating. And I think that's natural because DFIs really have a very different type of focus from a bank where there are shareholders who are hoping to minimize the risk and optimize the profit that they're making and write good credit. And rightly so. So I think, though this is starting to change, so I think in this sense, when you're looking at captive power, the bank will really be thinking about who's a buyer, because the risk there is a lot more concentrated. There is, might be one corporate, a large corporate, an industrial one, for example, that might need it to run a mill of some sort. So in that case, it really comes down to the bankability of the underlying. In a sense, you're doing almost a credit rating on the actual client at the end, the person sitting at the back. Because the question is, what happens if that person goes out of business? So the infrastructure sits there. So can you actually do something with it? And I think with power, yes. I mean, power is fungible. So the question is, if you have a solar plant or geothermal or whatever, they're serving one client, you can send it somewhere else. So I think that is really important. So what type of power is it? How easy is it to reroute it? And what's the quality of the buyer at the other end? Would be the things that the banks would be thinking about, and how to mitigate them. However, I think it is certainly changing because this market's getting a lot more competitive, is getting a lot more structured. So, looking to your question around what solutions we're seeing that are different. If you look at, and this has really nothing to do with power, but if you look at some recent securitization transactions that the government has done, where there's Kenya Roads Board, soon there will be the Railway Development Levy. So Kenya Roads Board was going to pay contractors, etc., through an SPV, a bridging loan from the banks, and then eventually that bridging loan will be taken out with a bond issued on the Nairobi Securities Exchange. These are big sizes. I mean, it's north of $1 billion, this type of transaction. That's novel. That's new in this market, which means that the path is being laid. I mean, government, a bit like a DFI, can tread where other people haven't gone before. And then the private sector can start to follow. So I think certainly what's starting to happen in this market and what we're seeing as an investment bank is a lot more sophisticated transactions, a lot more structured transactions, a lot of people looking to securitize receivables as well. There have been these transactions in the market and there are going to be more of them. And ostensibly to just release cash back into the cycle. Rinse and repeat, which is seen everywhere else in the world. So I think in this market, we were always quite reluctant, and I go back to how structurally profitable banking is in this market relative to other parts of the world. As those margins squeeze, banks have to be more imaginative, which means that they have to listen to more different types of structures and be able to fund those, which then means we need to build the skill pool to be able to analyze those transactions. Because sometimes you'll find the problem is not that the bank doesn't have appetite, is that the knowledge isn't necessarily there. But I think what's happening now is that there is demand for this knowledge. It will come. It is coming. It is there. There is knowledge transfer. So I think the future looks bright from my perspective, from us sitting in the investment bank. And whether it is in different parts of the economy, eventually will come down to power infrastructure, for sure. Thank you.
All right. Thank you so much for that elaborate answer. I want to ask 2 questions and then we come for questions from the audience. So my next question goes to, Joseph. In regards to financing and where you sit probably at UNDP, what structures have proven most effective in unlocking early stage or small scale energy projects? Because I know most of the energy projects here might not be that large. I know you said you go for the big, but from where you sit and maybe practices from elsewhere, what are some of those strategies that would work for early stage or small scale energy projects?
Okay, some of the approaches that maybe would be practical in our situation is what I would call layered capital approach. For some of the projects at a preparation phases, some of the developers may not be able to absorb the risk. So we are looking at provision of grants. We have first loss capital, something to look at. Then we have concessional financing. And for some of these projects, what we have seen, for example, a geothermal project, how much does an exploratory well cost? Not less than $20 million. Now, how many developers will be able to take that? We have seen for some of the local developed projects, some of the developers are not able to fulfill the requirements of DFIs in terms of full feasibility studies, ESIAs. You know, there's the issue of gender, community. It costs money. Yet, probably this developer had only, let's say, $2 million, maybe part of equity and maybe some money extra somewhere. But even the project preparation is quite costly. So through Energy for Growth, that's where we started. We thought we could come in and start financing projects, only to realize that some of these nice projects actually have not done some of the important technical visibility or designs. And if they had done, they are not up to date, or it's not up to the level that a DFI would look at. So we did propose grants, and through that we have PISTA. It's a platform. It's a platform for investment support for technical assistance, and we did start in 7 countries. Each project was given around 170. Through that, we attracted more financiers, and this year they are going to give every project $450,000 just to maybe bring it to that bankable or almost bankable level. Last year we had a project on mini hydro. We have a bioethanol project, and through that we 170 has actually unlocked $20 million just to bring it to that level. So we have seen a lot of interest. The mini hydro, 170, they have 3 potential financiers lining up to give $10 million. 2 of them are local banks. So that shows how easy it is to actually bring some of these local projects that may not be very attractive to a bankable stage through grants. The other point is portfolio-based aggregation, where you have a number of projects, make it a portfolio, and then it's more interesting, more appealing to some of the financials that we have been talking to. This year, we had a mini hydro developer who had about 3 projects. But when you look at only one project, doesn't make economic sense. The transaction costs are too high. So what we did advise, can you create a portfolio, and then you have an ask of $20 million instead of less than $10 million or $5 million, which one was requesting. So some of those are the approaches that we have seen. In terms of policy, because sometimes we do the hard things and then we forget about the software, we also have to think about de-risking the neighboring environment. That's what I would say. For example, a few years ago, yes, EPRA said, okay, we'll give you PPAs even for CNI. Now, there's a new requirement that you need battery energy storage. Let's say as a developer, you are already discussing the financing with potential financiers. And then there's this new requirement. What does that mean? You have to go back to the drawing board. Thank you.
Thank you. Thank you so much for that answer and also the different examples you've given. I like the last one because one of the research you've been doing is the cost of batteries in energy storage, particularly for solar, that becomes very high. So our solution is to try and see, would Second Life bring that cost down? There is potential of about 28 to 50%. However, of course, we have to test it more and see how it is going to work. So back to you, Marete. How, for instance, I mean, one of the things also is to lease the batteries, right? So if you're considering some of these projects, I just want you to take a little bit of time to spend on the journey when it looks to a client, particularly when you're looking at leasing, right? You can give an example. And so when I'm starting this, give me the journey that I'm expected to take. And also, what are some of the points typically will be friction points in this journey? And how can we navigate around that, particularly with the support of banks and NCBA, for instance?
Thank you. Thank you very much for that question. Just to mention, the first level is that leasing may be combined with other forms of financing. That's just an item that I need to mention. And one of the things is that you may find the first, let me just walk you the journey as I talk through the obstacles. But the first step is basically to size the project. So we have partners who are EPCs for this particular case, who will come and size the project, give us the value, then we take it through the process of review and see which in this project are leasable assets. If say you are doing excavation or civil works, then those obviously will not create assets that we can be able to hold on to, so they're not leasable assets. So in that case, then we will pass that portion of the project, will pass you to another form of financing. But now there is this asset that is created, that is identifiable and movable and all that. So once we identify that and we get the base pricing, then we work backwards and create the lease rentals that we share with the customer. So unlike the PPAs where we give you the tariff, in this case we will give you the periodical rentals over the time. We prefer splitting it into 2 or 3 sections. The initial session when the project is very new and generating to the full capacity, then you pay high amount, but obviously below what you are paying the grid power for. Then after 5 years, because we obviously understand the system will have not so much degenerated from the experience we've had, they are actually still optimal, but we want you to have more savings towards the end. And then after that, then you keep the system. So after the sizing, we create the rentals, the amounts that you're supposed to pay per month or per quarter or annually. Then you go to the next level. Now agreeing with the customer on is happy with these rentals, then we have to contract. So for this purpose, we'll give you an agreement that shows the do's and don'ts. You review them. If it's a sizable project, obviously there is room for negotiations. It's a very small project. We have template that you create and so that we sign off and move on. So once we sign the agreements with you as the customer, then we go to the next stage of now contracting with the EPC. So the customer will have signed our terms and is agreeable. So we will sign with the EPC and give them our commitment letter, depending on the arrangement we have, whether it's LC, whether it's LPO, whether there is a down payment and all that. We have an arrangement with the EPC on how to progress from there, depending on the kind of engagement we have with them. So once we have contracted the EPC and we have the timelines, ourselves and the clients, we work through to make sure that the project is delivered as per expectation. So the last instrument is obviously now to pay there is a portion of paying the EPC provider, and if there is a retention to be kept, then we have an arrangement on how to hold on that fund to make sure that the project is well taken care of to the end. Then there is now the part of asset management, which is basically looking at the project. Is it delivering what it was promised to do? Are there hitches? And if they are there, then we intervene in time, because remember our funds are at stake. If the customer is not getting power, I tell you, as much as he's generating money from elsewhere, you'll struggle getting your money. So it's our interest. We've got a whole team that takes care of that, making sure that what we promise is actually what we deliver. Yep. Thank you very much.
All right. Thank you so much for that elaborate journey, Marete. Now that I've done my bit, let me come to the audience. So you can take a set of 3 questions.
Coming back to the theme of financing captive power, I think one of the key words we keep hearing is bankability. Are your projects bankable? And William, you kind of asked a question to Muathi, asking how can corporates sweet talk banks so that they can lend them money? But I see banks are here now. You know, I think Muathi did mention that this is a space. Traditional banking has been very profitable, but increasingly they're coming to the table with regards to financing captive power. And just circling back to the issue of bankability, one of the challenges I find, and I'm sure this is common to most of the financials, is you don't get a lot of well-developed projects. There's a lot of funding available, but these projects are not bankable. And the reasons are various. You know, there's a lot of variability from, developer to developer, uncertainty, which creates a lot of uncertainty for the financiers in terms of who do I believe, in terms of the KPIs or the specifications that this project is bringing. And we talked about portfolios, but, we are fairly at an infancy stage of the market, if I may call it so, where you find there's a lot of developers. So not everybody has a portfolio that is well, developed, so to speak, and ready for financing. So sometimes you have to finance individual projects. As a result, there's a lot of projects out there. I think amongst developers, you'll all agree with me. None of us rarely see a brand new project. You go in there and you find this customer has been sitting on 10 or so proposals, but because of the variability in development, there's a lot of frustration and it's leading to a lot of negative reputation, on the solar industry or the renewable energy industry, for that matter. So what interventions from where you sit would you like to see with regards to having developed project, transparent development guidelines, for example, and so on. And I probably want to ask this to probably William, and maybe let me ask and Robert. Want to hear your perspectives on that. Thank you.
Yeah, thank you. Geoffrey Rono with Ofgen. Just to echo the comment around equity, I think the debt side of the equation has, the market is now quite mature. Local banks, NCBA are here, and the other players are quite active now in our sector, taken an interest, and they're very, if I have a project now and I approach many banks, they will respond to me. But the equity side of the equation is still quite, especially local investors in terms of equity are not yet there. We still see a lot of foreign equity partners working, and that has its own challenges. So question here is, how do we encourage local investors, mostly the pension funds, to participate in the sector? I think we have seen some interest, and a question is open to anyone here who may wish to respond to that. Thank you.
My question is actually to Winnie. Though part of the question Rono has taken it, maybe a follow-up to what Rono has just said before I ask Winnie. I've seen local equity go into road infrastructure. So I think there was a hand of government. I say so because I'm in pension industry as well, and we need to encourage our pensioners to invest their money in our infrastructure here, even in energy. Winnie, you talked about customers coming to you not because solar is cheaper, but because it's part of the input that they require. My question to you is, how do you de-risk repayment? Does it mean that at the end of what, is it pay to own? Because you said it's not lease. On the lower side of the other side, let me not call it lower, there's pay as you go for people who probably have a software. If you do not, like MGAS, if you do not pay, you cannot access. But in your case, I would imagine you can't deal with lack of access if you do not pay. So how do you de-risk your repayment in the long term?
The due diligence is actually on the end customer. It's not even on us as the developer. And in the markets that we're in, there are no customer scoring models like in the US or abroad. So every due diligence we do is very manual. And that's why we rely a lot on data because we own the system. So it's not pay as you go, but we own the system. That's our model. We own it. We install it. We maintain it. It will remain on our balance sheet. What the customer does is just pay for the kilowatts that they use. And so that means a lot of the risk is on us. And we will spend time as well. We use a lot of software, so it doesn't take that long. But we will look at your bills. If you come to us, you want a cheaper solution. So solar is cheaper than the grid. That's the whole idea. And the only reason the customer is sitting across from you at that time is to see how you can help them lower their bills and not, if they can avoid paying upfront, because it's quite expensive. They don't want to pay upfront. They just want a cheaper deal. So what you're doing is due diligencing them. So you're asking them for their bills for at least 12 months. You're putting data loggers at their station so that you can see what the actual consumption is. You're going through whatever accounts they give you to try and understand who this person is and to try and estimate, will they be in business 10 years from today, 20 years from today, or will I be left with an asset that I now have to decommission and send it to somebody else, which you don't want to do. A lot of the work is on actually trying to understand if this customer is somebody who will be I can generate cash flows for at least 20 years because the first 5, 6, 7 years, you're just recovering your capital. So if they go bust at that time, that's a disaster, basically. I don't know what the other question was. You said a lot of things.
Right. Okay. Thank you. Let's try and get to the
end. Still talking. Sorry. At the end, you talked of decommissioning, but if it is not decommissioned and the customer is still in operation, so do you transfer the assets to them or you decommission?
So the system always belongs to us, but in our solar contracts or our power purchase contracts, we have purchase options. So at any point, you can own the system. And it's part of the contract. You can, if after 5 years you want to buy the system, it's fine. We'll sell it to you. You already know the prices upfront. So everything is upfront. Before we build a single thing, we have agreed on what's your load profile, how much are you going to save, how will we design it? All of that is known ahead of time. What will we charge you? Typically for us, it's a percentage of the grid price. So you already know, everybody on the table knows what's happening. And at any point, you already know at year 5, I can buy at this price, year 10, year 15, year 20. If you don't want to buy it, that's fine. We will decommission it. We've not gotten to the 20-year mark yet, so we don't have any systems that are that old. But if you don't want to own the system, we will decommission.
Okay, thank you. Marete, there's Anthony's question.
Thank you very much. Anthony, you got us there because one of the things that bankers don't say, they're like lawyers. They depend on historical information to predict how the future will perform. But that's not said. What you're looking at your financials. So what has happened in the past? The first sort of 7 years ago, thereabout, passing it through the credit committee was a hard task because you had to give them historical performance of previous projects and how they ended up so that you can convince them that this will perform. Fortunately, the first batch of projects that we did were excellent and the savings are out of this world. I even feel like I was cheated when pricing it. So how do you get there? There are two ways, like I mentioned, depending on the project, because the project you can see, they have a lifespan of say 20 years. But the normal ordinary finance transaction, except Muathi there who can be able to go beyond that in terms of structuring. If you want to get a facility from the financier, then the right thing to do is to do an hybrid. You may get some patient capital that can come in and de-risk the financier, especially on the leasing model. We've seen structures where we come in as the leasing entity, fund a project up to say year 5, year 7, then we step out. Then another, either DFI or a partner who has a bigger vision for this project continues their own. So this is possible to do, but with a consortium. Beyond that, obviously the investment banking would solve for projects that would ordinarily not sit on the bank book easily. Yeah, thank you.
Right, for Rono's question, before you go back to the audience, about equity, are there any answers to that? Have you seen any projects that, maybe Nicolas, where equity has been involved in financing projects?
Yes, so I fully agree. I think what you're saying is that now the main bottleneck on the sector is equity. I think I mostly agree on this. Regarding on how to make equity investors come, well, it's the law of the market. So basically it's about how well the risks are mitigated. I think we already mentioned the risk, but also whether the returns are high enough and safe. So yeah, it's about increasing the returns, so making sure that the company is lean and efficient for this. I would say also to have more, you were mentioning the need for local investors. Well, I think the need for this is to consolidate a bit the market, having bigger players so that you can have bigger tickets and the risk is a bit more spread. But also, I think it's quite important to, well, do the preliminary jobs for them, both in terms of valuation when they come, making sure all the, the existing shareholders and your investors are aligned in terms of valuation. So having fully auditable financial models, etc. And I think one key point for equity investors as well is to have vision on their exit options. And so, yeah, I think that's also one of the reasons to, to get financial experts to advise you on this for future, refinancing for the exit or shares buyback, these kind of solutions, which are quite key, I think.
Anyone else with, all right. How many questions? I want to take the last set of questions and then we can get concluding remarks. So you can prepare for your remarks, what you'd want to say. Any other? So those are two. Okay, let's take those two.
Wanted to build on the question from Anthony, and I know you've answered it, but are there some lessons learned in terms of dealing with customers? I'm looking at the customer side to avoid or to reduce the time it takes to close a deal. There's some lessons learned in terms of simplifying the contracts for the different kind of structures that we have out there. And are there some, say, bad experiences with the project so far that are giving us some lessons in this space, in the captive space?
In a nutshell, looking at the environmental point of view, I'd like to ask Nicolas, how do you handle the electronic waste at the end of life of your project, and how do you cost it into your models?
So yeah, basically we make sure that on the long term the portfolio is well spread in terms of PPA durations, that we don't have all the PPAs hitting at the same time, to make sure it aligns with the debt terms. So I wasn't sure of your question. Can you go back to it, please?
Well, you've developed your project and maybe it's gone into the closing section and it's actually outlived its life. So you have equipment, solar panels, you have batteries, and now that turns out into electronic waste.
So, I mean, I'm not really a developer. Maybe
I was going to give it to Winnie.
Yeah.
You carry the projects, and he's asking about e-waste after these projects. Do you account for that? Maybe Nicolas would have been, is there foreseeable costs that you put on e-waste that can be recouped at the end of the end life of the projects, maybe? Yeah.
I think we're still a bit new in terms of getting to the stage where we've actually had to decommission large amounts. At the moment, what we do is we can sell scrap, but what they do with the scrap is the question, because it's very easy for me to hand over to someone, but I don't know I can't say exactly what's happening. Maybe Anthony can help.
Maybe I can speak to that, because yes, a lot of projects have not reached that 20-year cycle, 25-year cycle. And even at 25 years, there's still energy being produced, so they could actually be repurposed. But I've seen interesting companies starting to look into that, talking about being able to buy and recycle most of the material that is in there, taking it back to manufacturing grade silica and so on and so forth. And so it's actually something that is there. I know at EDF, we actually do have end of life procedures that we put in as part of contracts to our customers. But sometimes a contract is only as good as having the actual procedures in place when that happens. So today, do we have recyclers available in Kenya? Not so much. Most of these will end up going to scrap and so on. But I do believe increasingly there is an industry that is starting to look into this and consolidating a lot of the waste that comes at the end of life to sort of now start to figure out what to do with it. But in a lot of models where the banks maybe are giving you a 5 to 10 year facility, developers are giving you a 20-year PPA, you still have more productive life of that asset, then at that point, unfortunately, the reality is that the onus to act on the electronic waste is actually on the end customer, because the customer ends up owning it for the last 15, 10, 5 or so years. But I believe I've seen, the shoots of a recycling industry that is increasingly being creative about what to do with recycling a lot of these components that come from the power plants. Thank you.
Thank you so much for that, Anthony. Your question. Yes. Anyone to answer that question from some? Lessons from bad experiences from customers. And this also, anyone from the audience as well. If you have a bad customer experience, or if, I know Marete said they behave like lawyers, they don't mention bad experiences. Anyone with an experience that was not very good? Yes.
The experience was more or less under Robert's model. We had utilized the internal company funds to create a lease for one of our clients. Unfortunately, the client went under receivership. So we found it really hard to recover the asset from the client's premises. And the experience has been a long and unending one. I think it's still ongoing. So how do you go about a situation like that, if at all you've gone through it?
I was
Have
hoping,
you foreseen?
I was trying to avoid, I don't know his name, I was trying to avert my eyes because we have so many bad experiences. Because what happens, like sometimes you even see the red flags from the start. So again, without mentioning names, you're so desperate for the kilowatts. You really want to grow your business. You've already received funding. And so you go, you ask for the bills. You find that the person has even been curtailed by Kenya Power, which should already tell you, if Kenya Power has curtailed this person, they will not pay you. You go ahead to build hoping for the best. After 1-2 months, they stop paying you. They stop picking your calls. They even tell you, what will you do? You can go where you want to go. They tell you, we know the small claims court will only take you for, I think, is it $1 million? So let's wait until it gets to over $1 million so we can get real lawyers. So we've got so many of those where you're constantly debating, do I curtail this person? Do we just go and get our system? And in some cases, the contract says the system belongs to us. You go there, they lock their gates. They don't let you in. Yeah, you can go get the lawyer, you can get the police. So yeah, we do have lots of bad experiences, unfortunately. But that shouldn't deter us because that's a very small, of the customers that we have, that's a very small subset. The most of the customers are in business to make money. They're good commercial people. You'll find that the people who behave this way are actually in problems. Like the business is actually going under, and that's why they're acting the way they are.
My name is Elizabeth Muriithi of KCB. I know we've dealt on the banking side, we deal with the EPCs. Once we had an EPC who said they could install a system in certain customers' premises, but the experience from the customer was the system was not working. They did not install what they said they would install. The equipment is substandard. So we are stuck there. The EPC has been paid, has gone. The customer has come back to us and said, whatever was installed is rubbish. So why are we paying for the facility? And then two, you're the guys who sort of recommended that particular EPC. So I think banks will normally now refrain from saying or recommending a particular one. We'll just give you a list of the ones at least we have tried to vet, and we'll try and vet on the equipment side again, so that then ourselves as bankers, we're not compromised, because if the equipment is not working, my money is out there, it means I am like butt naked. So yeah, we also have terrible experiences as bankers, but we learn every day. Thank you.
Right. One last question for this gentleman who's standing with the mic, and then we take the last comments. I think it's a very interesting question on carbon markets. We've not talked about that. We can hear that question, and then you can consider that as you make your final conclusions.
So recently we have seen a lot of publishers from the registries. The gold standard have published a methodology to accommodate renewable energy projects to get carbon credits. And we haven't seen a lot of projects taking up that route. So my question is, how do we all support developers to structure their project as carbon project, turning the carbon credits as assets that can be bankable?
So I will start here all the way to the end. Consider that question as you make your final remarks. Thank you.
To be honest, I'm sorry, but I have no experience in carbon credits, so I cannot really bring any value added here.
concluding remarks as we go. Anything you've left you wanted to say? You said everything. Okay, thank you.
Yeah, I think that's a great question because of course, we're in the renewable energy space. The projects that we develop, we actually track the carbon the emissions. We have dashboards. We have a lot of data anyway in-house that can tell us how much carbon we're emitting. I think it's something perhaps we could speak further with you on because, and this could just maybe be bad experience from the past where registering, it's just a lot of work to get. I mean, it sounds easy when people say, just go and sell this on the carbon market. But you have to go through this gold standard, I think Vera, you have to go through a lot of verification. You literally have to almost have a science in how carbon accounting is done. So it's a tremendous lift. So if you can help us, because we've got the data of how much we've emitted, but if you can make it easy for us to be able to give you that information and get the money, then that's fine. But if we have to hire somebody and then really go through these hoops just to prove to you that it meets additionality and all these other criteria, yeah. So that's the hurdle that I'll speak just as me as Winnie. So I'm not speaking on Equator Energy. In terms of my closing remarks, and okay, this might sound like I'm knocking KPLC, but I wish that we would finalize on the wheeling, because we are in the stage as a sector where we can use, let's say, AI or software, where you can build large solar farms. Maybe we can come together with other developers and build large solar farms just in the middle of nowhere, maybe North Turkana, and sell this, bring this power to, and just wheel it to give it to our customers. But it seems like we're not there, and I think the issue is because, and this is just my perception, people like KPLC are very concerned that they will lose large amounts of revenue from the big, from their big players. So if we could just finalize that, I really think the captive solar space that we are in would really take off. Yeah.
Thank you, Winnie. Marete, just quickly.
Thank you very much. I just want to mention on the carbon item, we've seen the regulator trying to follow closely and basically guide banks on their reporting, basically in that direction of their carbon print in terms of the book. So it's not there yet. We have not yet started reaping it. Like she has just said, the complexity of the process of proving that these are the number of tons that I saved and went in that direction is a bit tedious now. But with the regulator going there, I believe soon we'll be there. So my closing remark is just to mention that for C&I, most of the tickets you see in between 50 million, they are easily deployable through leasing. So we don't really need to overthink because the asset itself is self-securing. The turnaround time for this project, given the experience, today you find between 1 and 5 days. For a project below that 5 million, you have an approval. Go ahead or install it. So I think it's something to consider because it's self-securing, it's easy, and the engagement is simplified nowadays. So thank you very much, and have a good afternoon.
Thank you, Marete. Joseph?
Yeah, quick one. I think energy financing, I always say it's like marriage scene. Developers say they are not financiers. Financiers say they are not bankable projects. So I hope there can be a meeting point for the two. For energy for growth, from energy for growth perspective, I think the priority is not only to have good C&I projects, but actually to have a good pipeline of bankable investment-ready projects that can be matched to the right technical assistance grants and also capital. Thank you.
Thank you so much, Joseph. And finally, Mr. Kilonzo.
Yeah, thank you. So a couple of things I noticed as I close off. So on the equity side, I think there are green shoots And it's really more a function of pension contributions have gone up. The capital markets are going to be at a point where they can't absorb all this capital, which is going to have to force the pension funds in particular to start looking at alternative assets. We've started to see that in the form of things that perhaps people can understand. So Talanta Stadium was funded through what is an asset-backed security, for example. I think there was something in the room talking about pensions also investing in the roads. So the Mau Summit Road, for example, from Nairobi. So they will go there first, and then eventually they will come to looking at power assets, for example, and writing the equity check, which makes sense because these are long-term assets that match the asset liability mismatch that sometimes they struggle with. And in many situations may actually give them some FX diversification that they may want to get. So I think the equity story will eventually change because the market is getting sophisticated, and it will come. Doubling on that, the one thing that I have noticed I haven't seen is power producers tapping some of the tax exemptions that you get from being a sustainable or green bond issuer. If you look at this market and the people who have issued green bonds, it's a student housing company, it's a telecoms company, and a mortgage finance company. So I think for the developers and the people who think about these things, there's certainly a different type of financing, which is becoming quite attractive because the tax break means that you pay less to the market, but grossed up, it's quite an attractive yield to whoever buys that instrument. And the public debt markets are getting deeper and they're getting more sophisticated and looking for diversification. So I think that's something that should not be underestimated. So tying all of this together, how do us at NCBA help you? I think how does Marete has explained his solution? Where does the investment bank come into this? And this goes to one of the earlier questions. How do you make a project bankable? So the way we work with, say, the leasing business, the corporate finance, the corporate banking business and commercial banking, which sits in sort of SME side, is that we're getting into the conversation earlier. So the investment bank isn't coming at the end when you're looking at sort of closing the financing round. It's coming right at the start of the conversations in the first meeting, because the one thing that people do need to be told is how you think about your capital structure and how you put your deal together so that it's bankable. And more so than that, we help the bank in order to get it through the credit committees, because in a sense that is the same sort of test. So that's how we're helping. And hopefully we'll see some of you in our offices at some point. Thank you.
Thank you. Thank you so much, lady and gentlemen, for that conversation. Maybe if I just say something as we close, George, there's an opportunity for the next one, next year, to have a deal room where marriage scene in energy sector is created. Bring investors, the bankers. Maybe Kilonzo can sponsor that deal room separately for conversations to happen. Yeah, I'll come for my paycheck invoice after this. The other thing is, I think Kilonzo said something which is, I don't know if anyone has captured this. On a lighter note, we are going to have another levy from this government. Kenya Railway Development Levy, securitization again. Your pockets, right? Tighten them up. And I think for me, this has been a power panel. Thank you so much. Can we give them a loud of applause for that?